All right, this morning we want you to take a moment and kind of reflect back with us. And we're going to talk about finances this morning and really kind of talk about maybe what we've learned over the past year, because I know a lot of us learned quite a bit. And joining us this morning, we're so happy to welcome Ray Ferrara back with Provise Management. And this is going to be an interesting one because I think there's still going to be lessons to be learned as well. But Ray, so good to see you again.
Probably nice to be back with you, and good morning to everyone.
I'm so happy that we are at a point, a year later now where we can kind of look back now and say, okay, in the finance department, a lot happened in the world. What can we learn? How can we do better? Where do you want to start, Ray?
Well, let's go back to January 1st, 2020. Life was good. Economy was roaring. Markets were doing well. And hardly anybody had heard the word coronavirus here in the United States. And if they had, they weren't really worried about it. And it only was about 4 or 5 weeks later that we started to see some kinks in the armor in the market. And in 6 short weeks, the market plummeted 34%, the fastest bear market we've ever had. And unfortunately, a lot of people panicked and sold. At that particular time, we told our clients, hey, this is not an economic event, it's a health event that's causing it. We'll figure out a way to get our way through it. And don't panic, don't sell. And March 23rd, down 34%. Some people are still out of the market, still have not gotten back in, and have missed a tremendous run-up over 75% on the S&P 500 and almost 95% on the NASDAQ exchanges. So lesson number one, don't panic, don't get out, stay in the market. It's the time in the market, not the time out of the market.
So here we are a year later now, that still holds true. That's still even everything that we've been through over the last couple of months. What say you today?
Well, there are some brave souls out there that did jump into the market, and as I just mentioned, they were heavily rewarded. There's a few maxims to consider. One is buy when blood is running in the streets. When everybody else is fearful, that's the time to get in. And the time to be selling is when everybody's cheerful and overconfident and thinking things are going very, very well. The real question investors need to ask themselves is not whether things are going to be better or worse a month from now, a quarter from now, even a year from now. Is do they think the economy and the markets will be better 5 years from now? And be a long-term investor and don't panic in these types of situations.
And I would imagine, though, it depends on where you're at. If you have the 5 years to wait, and I'd imagine it's the team that has the experience in knowing how these trends go, that's got to be crucial into making these decisions.
No question about that, and everybody's situation is different. People somehow magically think that just because they're 65 and are retiring, that they don't have 5 more years. They do. In fact, the average couple retiring at age 65 is going to have a life expectancy of somewhere around another 22 to 23 years joint life expectancy. What everybody needs is to analyze their risk, have a good diversified portfolio. Last year, when the stock market was plummeting, bonds were going up and continued to go up throughout the year, even though stocks were recovering throughout the year. We saw last year tech stocks and healthcare stocks doing absolutely fantastic. The value-oriented stocks, those name brands that we all think about, banks, they were doing horribly. Now there's a rotation occurring over the last 3 or 4 months where tech isn't doing nearly as well as it had over the last 10 months or so. And one of the big mistakes that people make, even in these non-pandemic years, is that they start investing their money on last year's winners. Unfortunately, last year's winners are rarely this year's winners. And so that's why it's important to have a good diversified portfolio of stocks and bonds, growth and value, national, international, real estate, to dampen the risk and the volatility.
All right. And Ray, as we close here, you have a great special offer that you want to extend to people watching this morning.
Well, we've talked an awful lot about diversity and risk, and so we're offering a no cost or obligation risk analysis of your portfolio. So if you mention Morning Blend when you call our offices, we'll be delighted to provide that to you.
Ray, thank you so much. We appreciate your time. We look forward to seeing you again soon.